Everyone thinks they know why Walmart is fleeing California. The news cycle is dominated by viral videos of shoplifters sprinting out of stores with armfuls of goods while security guards stand by helplessly. But the CEO of Walmart just dropped a financial bombshell that proves the real thief stealing the future of American retail isn't wearing a ski mask. It is something far more dangerous, far more systemic, and it is silently erasing the economy of the Golden State. If you want to understand the hidden financial forces that are actually reshaping your wallet and your world, you need to subscribe to Tax Hack Pro right now. We don't just read the headlines. We follow the money to tell you what is really happening. Over the last 18 months, the retail landscape in California has been decimated. 6 major Walmart locations have permanently shuttered their doors. More than 500 jobs evaporated overnight. Entire neighborhoods woke up to find themselves disconnected from the supply chain they had relied on for decades. When the explanation from Walmart's executive leadership finally arrived, it stunned everyone who had bought into the simple narrative of crime and chaos. What is happening in California is not just a story about a few stores closing. It is a warning signal for the entire American economy. We are witnessing a fundamental restructuring of how commerce works, and if you aren't paying attention to the balance sheets, you are going to miss the shift until it hits your own town. Let's strip away the sensationalism and look at the timeline, because the sequence of events exposes a brutal economic reality. In February of 2024, Walmart executed a swift exit from 5 separate locations across California. There was no fanfare, there was no long goodbye. Employees showed up for their shifts only to be met with locked doors and severance packets. The decision had been made in a boardroom thousands of miles away, based on a cold calculation of risk and return. But Walmart was just the tip of the iceberg. This was part of a cascading failure across the state's retail sector. On April 5, 2024, the retail world was rocked by an announcement from 99-cents-only stores. This wasn't a restructuring. This wasn't a Chapter 11 reorganization where they close a few underperforming locations to save the ship. This was a total liquidation. A 74-year-old institution, a lifeline for the working class, announced it would vanish completely. All 265 California locations were slated to close within 60 days. Think about the sheer scale of that economic displacement. In a span of 2 months, 14,000 people were thrown into a volatile job market. 14,000 paychecks vanished. That is not just a statistic. That is a localized recession. These stores were not just places to buy cheap household goods. They were economic anchors for their communities. They provided local tax revenue, first jobs for teenagers, and essential goods for families on fixed incomes. When those lights went out, the economic shockwave rippled through every neighborhood that depended on them. The carnage didn't stop there. The pharmaceutical sector, a pillar of stability in most economies, began to crumble under the same pressures. Rite Aid made the drastic decision to close all 347 of its California pharmacy locations. Walgreens shuttered 12 stores in San Francisco in a single week. When Tim Wentworth, the chief executive of Walgreens, addressed these closures, he didn't mince words. He stated clearly that the current pharmacy business model is no longer sustainable. That is a terrifying phrase for an investor or a consumer to hear. When the CEO of a multi-billion-dollar corporation tells you the model is broken, they aren't talking about a bad quarter. They are talking about a structural obsolescence. They are telling you that the math no longer works. Big Lots followed suit, filing for bankruptcy in September 2024 and planning to close 75 of its 109 California stores. Target had already signaled the retreat back in 2023, pulling out of locations in San Francisco, Oakland, Pittsburgh, and East Palo Alto. The aggregate data paints a picture of systemic collapse. Since 2023, more than 1,000 major retail footprints have been erased from the map of California. San Francisco has lost 40% of its pharmacies in just 10 years. The retail vacancy rate in the city hit a staggering 22.1%. These are numbers usually associated with the Rust Belt in the 1980s, not the technological capital of the world in the 21st century. So when Walmart finally broke their silence on their California strategy, the world expected them to blame the flash mobs. They expected a diatribe against soft-on-crime policies, but that is not what happened. Walmart explicitly stated that theft and organized retail crime were not the primary drivers of these closures. Instead, they pointed to the unsexy, boring, and absolutely critical fundamentals of business. Financial performance, lease renewals, and profitability. This distinction is crucial, and it is exactly the kind of nuance we dig into here. If you appreciate analysis that goes beyond the talking points, make sure you're subscribed to Tax Hack Pro. We help you hack the matrix of financial misinformation. The public debate has focused almost entirely on theft because it is visceral. It makes for good television. It drives political engagement. But Walmart's internal ledger told a different story. Their decision was driven by profit margins, the skyrocketing cost of commercial real estate, and a seismic shift in consumer behavior. While they were closing 6 stores, they were simultaneously pouring $800 million into upgrading and remodeling other California locations. They completed 57 store renovations. They opened new stores. They converted a location in Mountain View. This proves that Walmart is not abandoning California. They are doing something much smarter and much colder. They are engaging in what Wall Street calls portfolio optimization. This is a fancy way of saying they are cutting the dead weight. In the old model of retail, you saturated a market. You opened stores everywhere to block out competitors, even if some of those stores barely broke even. The profitable stores subsidized the losers. That era is over. In the current economic climate, defined by high interest rates, high labor costs, and thin margins, every single square foot of real estate must justify its existence. Walmart is ruthlessly culling locations that do not meet strict return on investment criteria. They are redirecting capital away from struggling neighborhoods and into areas with stronger economic fundamentals. It is a logical, rational business decision. It is also a decision that leaves millions of people behind. The lease renewal issue that Walmart cited provides a window into the nightmare of California commercial real estate. In many parts of the state, property values have disconnected from the reality of retail revenue. Landlords, often facing their own refinancing crises and high tax assessments, are demanding rents that brick-and-mortar stores simply cannot generate. When you add in the regulatory tax of doing business in California, the higher minimum wages, the strict labor laws, the complex permitting processes, the high utility costs, the break-even point for a store moves higher and higher. A store that would be a goldmine in Texas or Ohio becomes a money pit in Los Angeles or the Bay Area. When a giant like Walmart, with all its negotiating power and supply chain efficiency, says the lease math doesn't work, it is a signal that the market is broken. If Walmart can't make it work, what chance does a regional chain have? What chance does a mom-and-pop shop have? This explains why we are seeing closures across every category, from discount stores to luxury retailers. The cost of operations has exceeded the potential for profit, but the most devastating impact of this financial recalibration is human. The 530 Walmart employees who lost their jobs are just the first wave. They join the 14,000 from 99 cents only and thousands more from Rite Aid and Walgreens. We are looking at a significant labor market disruption that is reshaping the demographic map of the state. The pain is not distributed equally. These closures are disproportionately affecting lower-income neighborhoods. These are communities that operate on thin margins, just like the stores that serve them. They relied on these retailers not just for employment, but for survival. When a Walmart or a 99 cents only store closes, the local cost of living effectively goes up. Residents have to travel farther to buy food. They have to pay higher prices at smaller convenience stores that lack economies of scale. They lose access to generic prescriptions. We are seeing the rapid expansion of what experts call retail deserts. Whole zip codes are being left without basic shopping infrastructure. Food deserts are spreading across the Bay Area and the Central Valley. This is the brutal irony of the situation. As Walmart optimizes its portfolio for shareholder value, it de-optimizes the quality of life for its most vulnerable customers. For the elderly, this is a crisis. If you don't have a car and the only pharmacy within walking distance closes, how do you get your heart medication? If the grocery store that sold affordable fresh produce shuts down, your diet changes, your health changes. San Francisco losing 40% of its pharmacies isn't just a business statistic, it is a public health emergency. Political leaders have been quick to point fingers at organized crime because it suggests a solution. More police, tougher laws. But if the corporate explanation is true, if this is really about leases, taxes, and margins, then police officers cannot fix it. You cannot arrest a high commercial rent. You cannot handcuff a shifting consumer preference. If the drivers of this collapse are economic fundamentals, then the solution requires a complete overhaul of the state's business environment. It requires addressing the cost of housing, the cost of energy, and the regulatory burdens that act as a hidden tax on every transaction. Walgreens CEO Tim Wentworth hinted at an even deeper problem: the broken economics of healthcare. Pharmacy chains are being squeezed by insurance reimbursement rates that are often lower than the cost of the drugs they dispense. They are caught between pharmaceutical manufacturers raising prices and insurance middlemen squeezing payouts. This is a national issue, but in California, where operating costs are highest, the breaking point is reached much faster. This retail transformation is also an acceleration of a national trend. The internet is eating physical retail. The pandemic taught us all to order everything from toilet paper to groceries online. That habit stuck. Foot traffic is down. When you combine declining foot traffic with rising occupancy costs, the physical store becomes a liability. Walmart's $800 million investment is a bet on this new reality. They are betting that fewer, better, more technologically advanced stores are the future. They are pivoting to a model where the store acts as a showroom and a fulfillment center for online orders, rather than just a place to browse aisles. This strategy accepts a harsh truth. They don't need a store in every neighborhood to dominate the market. They just need strategic hubs. The conversion of the Mountain View store is the blueprint. They are pouring money into areas where customer density and spending power support high-margin operations. They are essentially gentrifying their own footprint. Communities that fit the new economic model get shiny new stores. Communities that don't get boarded-up windows. This has implications far beyond California. California is often the canary in the coal mine for the American economy. If major retailers cannot make the traditional model work in the most populous state in the union, it suggests that the model is failing nationwide. We are already seeing signs of this contagion. Kroger has announced plans to close 60 underperforming stores nationwide by 2026. This portfolio optimization is becoming the standard operating procedure for every major board. The implicit social contract of retail, where profitable urban centers subsidized rural and low-income access, is dead. It has been replaced by a ruthless focus on individual unit profitability. The technology sector is also forcing this hand. Amazon has conditioned investors to expect efficiency. They have demonstrated that you can serve customers without the overhead of thousands of physical storefronts. Traditional retailers are being forced to defend their real estate expenses. If a store isn't generating a specific yield, it is cut. For consumers who grew up in an America where a department store was the anchor of the community, this is a jarring shift. We are moving toward a bifurcated economy. Affluent areas will have experiential retail, high-end groceries, and immediate access to services. Struggling areas will be serviced by delivery drones, dollar stores, or nothing at all. Communities are now facing a difficult transition. Local governments that built their budgets around sales, tax revenue from big box stores are staring at fiscal cliffs. They have to find new ways to fund police, fire, and schools. Residents have to change their daily routines. Some communities are trying to fight back. We are seeing experiments with cooperative ownership models, where the community buys the grocery store. We are seeing municipally operated markets. We are seeing partnerships with regional chains. But these are difficult, capital-intensive projects. They require a level of civic coordination that is hard to sustain. The outcome of Walmart's California strategy is going to be studied by every CEO in America. If Walmart succeeds in increasing its profitability by shrinking its footprint, expect the floodgates to open. Every retailer from Home Depot to Best Buy will look at their map and start slashing. However, if this strategy fails, if cutting these stores results in a loss of market share to Amazon or other competitors, it might signal that there is a floor to how much you can cut before you destroy your brand. But let's be clear about what this really is. This is not just a business story. It is a preview of the new American reality. We are witnessing the quiet shutdown of the Main Street era, replaced by an algorithmic economy where an Excel spreadsheet determines if your neighborhood deserves a grocery store. The 530 jobs lost at Walmart are not just numbers. They are people forced to navigate an economy that is becoming increasingly hostile to service workers. The communities left behind are testing grounds for a future where access to essential goods is a privilege, not a given. Walmart's CEO answered the questions, but the answers were more chilling than the silence. The closures weren't a reaction to a crime wave. They were a proactive move to align with the financial incentives of modern capitalism. Community obligation is a line item that no longer fits on the balance sheet. So here is the question you need to ask yourself. As this trend accelerates, what happens to your property value when the anchor retailers leave your town? What happens to your local tax rate when the sales tax revenue evaporates? If you want to stay ahead of these economic shifts and protect your own financial future, you need to subscribe to Tax Hack Pro. We break down the trends that others ignore. I am curious to hear your perspective on this. Do Do you think local communities can develop sustainable alternatives when the giants like Walmart withdraw? Or does this trend point toward a deeper, unsolvable problem in how we organize our society and our commerce? Is the future of retail just warehouses and delivery trucks, or is there a way to save the physical store? Share your thoughts in the comments below. We read them, and we want to know what you are seeing in your own neighborhoods. The real question isn't whether Walmart made the right call for its shareholders. They almost certainly did. The question is whether America can function when the profit motive dictates that millions of people should live in retail deserts. The answer to that question will determine whether California's retail collapse is a localized tragedy or the blueprint for the entire nation. The market has spoken, and it is saying that it doesn't care about your convenience. It only cares about the spread between the lease cost and the profit margin. Understanding that is the first step to protecting yourself in this new economy. Stay tuned to Tax Hack Pro because the landscape is changing fast, and we will be here to map it out for you.